First off, like to welcome and thank everyone for attending the call. In 2025, what we're planning on doing is showcasing some of the key positions that we own in our different client portfolios. So welcome to the inaugural show of that. In this first kickoff show, we have Dave Szybunka from Canoe Financial joining us. Dave is a foremost expert in the energy space, and through two of his energy-focused offerings that we'll get into in a bit, we've entrusted client capital to his guidance. By way of a short intro, Dave joined Canoe in 2011 and has 18 years experience in portfolio management and energy equity analysis. Previously, he worked at Rain Capital as the head of energy and portfolio manager. Prior to that, Dave was associate portfolio manager in Canoe Energy team. His career in the energy industry started as a financial analyst with Peters & Company, a well-known Canadian-based energy investment dealer. Dave has a Bachelor of Commerce in Finance from the University of Alberta and is a CFA charter holder. A little bit of housekeeping. During the discussion that I have with Dave, there'll be a few snap polls. We'd appreciate you participating in just to give us a little bit of an idea where everyone's heads at with the energy sector. And please feel free to use the Q&A chat, and we'll try and answer those more towards the end, or if it's topical, as we're going through some other stuff, we'll just go ahead and answer them. But no matter what, if we go a little longer, I'll make sure all those get answered. Welcome, Dave. We really appreciate you joining us today and giving us your insight on the energy sector.
Thanks a lot for having me.
Well, let's jump right in with, I'm sure, a question you could have never anticipated. Let's talk about our neighbors to the south first. We've got Trump, we've got drill baby drill, we've got tariffs. We've got some different interesting things happening in the basins in the U.S. as well.
You know what? Let me start that conversation with just a few things that I think are topical. And so, as it relates to the Canoe Energy funds, that's a good segue to, like, when you think about what do I own when I own Canoe, you own a global energy thought process. You aren't exposed to a Western Canadian mid-cap energy sector. You're exposed to a North American focused subsectors, global LNG, alternative energy. You look at oil, natural gas, power, refining. You look at all these various subsectors across energy, and we're looking at it across North America specifically. And so that's super important because, to your point, we haven't exactly had supportive energy policy north or south of the border for quite a few years. And what I would tell you is, when we made a very bold call last year, like, recall last year, geopolitical risk happening everywhere in the Middle East, oil prices are hovering around 80, everyone getting all bullish on oil. We made the call last year to take our oil weights down. We weren't seeing the right things fundamentally on oil. And subsequently, with that capital, we were like, we need to buy natural gas here. Natural gas equities, power, energy demand tied to AI, a bunch of these things were hitting the check marks for us. And so when we put those trades on, we bought a bunch of US names with that capital. We didn't just go buy a bunch of intermediate juniors in Western Canada. We bought the largest natural gas producers across the US. And our view was like, flow of funds, screen really well. Let's look at that. And so you fast forward to November of last year, and Donald Trump is in power. Well, when you meet Christopher Wright, who we know quite well, because he was the chairman of Liberty Energy Services, and he's now the head of energy. When you hear Chris Wright talk, you're like, this guy gets it. This guy understands energy policy, supporting the sector, wants to dominate oil, gas, uranium, all forms of energy across the US. And you leave that room going, I think I should have even more US energy exposure. So that's kind of, when you look at the Canoe Energy funds just today as a snapshot, we own roughly a third US relative to, that's probably the highest percentage we've had in quite a long time. And so south of the border, you can feel, I'll address this. Everyone, and Trump specifically, is talking about drill, baby, drill. And this is spooking people, right? Because people are going like, man, if they drill, baby, drill, this is not good for prices, and prices are going to go down. And let me tell you this. There ain't no drill, baby, drill. It's not a thing. It's a big flash in the pan saying this. But I would tell you, when you look at the sector back in 2014, hundreds of companies, no discipline, lots of capital chasing the sector. That was the peak. And management and boards of these companies got compensated more if they drilled more and grew more.
Yep.
Versus today, management and boards of these companies get paid more and compensated more if they hand back more money to shareholders. So there's no drill, baby, drill. But what I would tell you is there's build, baby, build. And what I mean by that is when you look at what's happening with energy demand tied to AI and big tech and sourcing power to build out all their chips, because they're in an arms race globally on big tech with China, with these other regions, they're going like, we need to get more power in America with American energy. And we need to push that in an aggressive manner. And we need to be supportive towards this build, baby, build theme. And just like we've had red tape up here in Canada, there's been red tape south of the border. It's been hard to build more pipelines. It's been hard to build more power facilities. And when you talk to Chris Wright, he's ripping off the red tape with Trump going, we're building it. We're building it. We're coming. We're going to have more power and use US energy and natural gas to build these power facilities. And with all that in a mixer, it's really good for energy. So I've talked about a few different segments here, but there's lots.
Yeah, I would,
lots
kind of doubling down on that a bit is being in the sector for a long time as well, or, having the ability to invest in the sector. I would say I've never seen so much shareholder friendliness that I've seen in the last, call it 4 or 5 years, with exactly what you said, more accountable to shareholders as opposed to just growing barrels for the sake of growing barrels, and not being accountable for maybe, what those barrels are going to be worth tomorrow. So yeah, that's a good point.
100%. Like when you look at a lot of people, when they hear the word energy, they think about risk and they go like, well, this is a risky sector. And what people don't understand is there's been a lot of structural shifts beneath the surface. There's larger and larger companies forming. There's oligopolies forming. These companies are spending way less on capital spending than they used to. To your point, they're handing back way more money. There's no equity raises happening. It's all share buybacks. So there's a lot of these shifts beneath the surface that points me towards the sector is just more healthy today than it's ever been. And I think the thing that we told our clients is just, we're in a theme of decarbonization. This decarbonization theme, I don't see it going away. And investors are kind of like, am I going to need it in 2028? And because they feel that way, it's putting a govern on the sector, right? When you think about how did the energy sector used to act? Well, 4 years into an energy cycle previously, the guns were back out and they were ramping up capital again.
Yeah.
And this time it is completely different because of this decarbonization theme, but that's really good for profits and making money as the discipline holds, right?
Yeah, I think that's the perfect word. Is discipline has been very strong for several years now. A bit of a backdrop to my next question is, 2024. We saw West Texas, kind of start the year around 70, got up into the 80s, down into the 60s, and sort of ended, let's call it, pretty much exactly where we kind of started the year. The two energy funds that we use of yours, one of them being more capital focused and one more of an income, deriving type of investment, both did in that 25% plus range. And it's been an interesting narrative, even meeting with some clients, wondering, how's our energy stuff doing? And they're actually quite surprised when you show them the results and the fact that actually it was one of the best performing, sectors of the portfolio last year. But it's met with a lot of amazement just as to, so I guess in a nutshell, I'm asking you, what were you doing to get these types of returns in a flat market?
Yeah. I mean, you brought it up. I look at our funds last year and our energy funds were up roughly 25%. And I actually feel like when I was talking to investors coming out of the year, I feel like we were down 25%. And the reason for that is like, if you kind of owned oil into the second half of last year, you kind of got beat up, to call it out, right? You think about stocks like Cenovus, they were $30 in June, they were $21 by the end of the year. Varen, Baytex,
Yeah.
oil prices flat last year, US Energy flat last year, CNRL flat last year. Like, if you just focused on oil, that you were in the wrong areas of energy. And our view at Canoe is like, well, oil is one component, but there's a lot of areas of energy, and the world's using more and more energy. So focus on energy as an energy fund, not oil. So when I look at how we did last year, we owned a bunch of power, we owned a bunch of natural gas, we owned certain segments within energy, global LNG, stuff like that, that did really well while oil got beat up. And so it's about these subsectors within energy and where you are within there, which is a big reason that we outperformed last year.
Yeah, and I know you rotate quite a bit and get into service companies and stuff from time to time, and and I know that adds a lot of value as well. Not just sticking, like you said, mid cap, heavy oil, Canadian, Western Canadian producers.
Yeah. I mean, this is a good chart to kind of talk to clients about when you focus on energy. I think the thing that we talk to our clients on is just like, this is a very investable asset class. When we look at energy, the world is using 50% more energy today than they were in 2020, or sorry, 2000. Like in the last 24, 25 years, energy consumption is up 50%. And you look at countries like China as an example, it's 4x their energy consumption since the year 2000. And so the world today is using 300 million barrels a day of energy equivalent. 250 million of that is oil, gas, and coal. So we're still using lots of hydrocarbons, but we're using lots of other stuff too. And the point of the matter is, when you look at the last 20 years, the globe on average has been increasing their energy consumption by 5 million barrels a day of energy equivalent each and every year. And we think this is actually inflecting to 6 to 9 million barrels a day of energy equivalent growth each and every year. Population growth, stuff like energy demand tied to AI and power. And so this is a very investable theme. And as much as it is investable, I find today no one really wants to invest in energy. Other sectors are working, tech's going up, all these other sectors are going up. And this theme is right in front of our face today. And the fact that no one wants to touch it is probably meaning you should be looking at it today while no one wants to.
So what do you think? I mean, there's lots of different things we could get into, but what do you think would be a catalyst maybe for a re-rate of the sector where, people start, I know no one's not just going to jump in and, in a huge way, but for investors to start to, notice, valuations are cheap, yeah, like I said, there's a lot of friendliness, there's shareholders, there's dividends, there's buybacks, all those things are happening in the sector, low debts like we've never seen. So what makes people come back in a meaningful way and maybe start that re-rating process in these different sectors?
Yeah. I mean, nailing the timing is always the hardest part. And look, we're constructive the sector. And if you've been, like my point is, if you've been in the right areas of energy the last few years, it's actually been pretty good.
Yep.
But when you just look at the last 24 months or so, the energy sector's kind of been flat, right? The sector's been flat. It's been bouncing around sideways. You're bullish, you're bearish, you're bullish, you're bearish. You're reading headlines about what's OPEC going to do. All of a sudden, oil has a 6 in front of it. It's very easy to get whipsawed as you're in what we call the digestive sideways phase. This doesn't mean the cycle's over, right? When we look at signs of going like, well, when should we get worried about energy? When you start to see companies aggressively spend because investors are like, well, we should be spending more. We have price spikes are happening. Geopolitical risk is elevating. All of this in a mixer. Consumer costs are up. Government policies are starting to backtrack. Consumers are going, who did this to me? Why are my prices and bills up so much? This makes investors go, well, we should be spending more capital. Today, to your point, when I go to conferences, we're just talking about dividends and buybacks. That's it. So this commodity cycle is not over. But because it's been going sideways, people are feeling like, these damn energy stocks are so up and down and volatile and this, and they're actually taking their exposure down and going to other sectors. Because in the last 24 months, as energy's been going sideways, yes, our Canoe energy funds are up. We've been in the right places. But if you just own the indexes or some wrong energy stocks, in fairness, other sectors have been going up. Tech's been going up. S&P's going up. Financials are going up. All these other areas in the market are going up. And if you said to me, what's going to cause people to come back to energy? It's actually other sectors quit working. The other sectors quit working. And every time there's a commodity cycle, it puts pressure on other sectors in the market. Think of it like it costs more for diesel and gasoline and natural gas. And this all puts a tax on these other sectors. And when that happens, it compresses the multiples in other sectors, which causes fires to start going off and going, oh my God, I need to sell these things because I'm losing money on them. It's a version of 21, 22. Inflation's ripping, other sectors are imploding, and our energy sector's on wheels. And everyone's going, get me more of that. I haven't felt that for 2 years because other sectors have been fine.
Yeah.
But we believe that if you believe in a commodity cycle, which we do, and you end a commodity cycle with a capital spending cycle, which we haven't seen yet, that is going to ultimately drive commodity prices up, and it's going to put pressure on these other sectors, which is going to cause the capital to rotate in. And everyone's feeling like it's over because it's just been going sideways. And we're actually at 3% of energy as in the S&P as a weighting. This is one of the lowest weightings on record. And people feel like it's over. It's like, I think we're at one of the lowest weightings on record. And this is like, start looking up while everyone else is looking down. And
Well, I know even when I started, in this business, we were a healthy, double-digit percentage of indices, and you're right, now we're kind of down to these low amounts.
well, and to kind of phrase it a different way, after we ripped in 2021, 2022, our funds were up 150%. You're just due for a breather to digest the moves. But investors rolled into 2023 bullish energy. They rolled into 2024 bullish energy. And again, because we've been going sideways for 2 years, I cannot find an energy bull in the room entering 2025. Everyone's bared up. Everyone's bearish. Everyone's worried. People have anxiety. And when we look at positioning now, like on the left of this chart, hedge funds, institutions, and retail are the most underweight energy they've been at since the COVID lows. So the positioning is very offside. And what I would say is you make money in any asset class with positive surprises. The lower you can set the bar, the better, because it just opens yourself up to positive surprises. And I would just say in energy, the bar is pretty darn low today.
And for the record, if we're talking 25% as a breather, I'll take a breather most years, just for the record.
Yeah, and that's fair. But like again, if that's a Canoe energy
Yeah.
comment, but energy has kind of been sideways, right?
So let's switch gears and talk just for a minute about OPEC plus. So a few headlines the last few days, Brazil's joining. I don't think that probably really matters all that much. They might delay the supply increases. You give me some thoughts around those, but more interesting is I read a ton of data about spare capacity. And I mean, you could drive a truck through what different people say OPEC spare capacity is. And maybe just to kind of double onto that question is, I think there's a misunderstanding as to how quickly they can bring that to market as well. So if you don't mind speaking to that.
Yeah, I'll maybe just throw out some high-level comments on OPEC because, like, I'm not a Middle East OPEC expert, but I would just give some observations on how we kind of look at things. So today in the market, to your point, OPEC has some spare capacity, and global inventories on oil and products, gasoline, diesel, crude oil, like they're quite low right now. Like global inventories are low. You even look at stuff like the Strategic Petroleum Reserve in the US.
Yeah.
It's the lowest level since the early 80s. Like if Saudi ever cut off oil to the US, like the US is very vulnerable here. but we don't feel this vulnerability on low inventories or strategic petroleum reserve because everyone keeps talking about OPEC spare capacity that in the market today is, to your point, 4, 5, 6 million barrels a day, some version of that. And so as OPEC spare capacity comes down over time, people will feel more anxiety about these inventory levels. So the question becomes like, well, when is this all going to happen? We were talking about it this morning just on right now, consensus is Trump's going to go after Iran. This is going to take 1 million plus barrels a day off the market. What's going to happen on Venezuela and some of these other countries, I don't really know. They've publicly come out and said they're going to refill the strategic petroleum reserve because they feel like they're very vulnerable and it's too low. And so there's kind of these things happening here in the market that could be quite positive for oil, but there's kind of this meh, yeah, but there's a bunch of OPEC spare capacity. It's just notable that most of that spare capacity is controlled by the UAE and Saudi. They control 80+% of the global spare. And in certain periods historically, the markets have bet, they were betting that the spare capacity would get added back.
Yeah.
And then they didn't add it back. And it really caught the market off guard. That's not my base case today. But I'm kind of sitting here going, there is a lot of complacency on this. That, oh yeah, Saudi's just going to add back all this spare. I'm just saying if they didn't do that, the market is completely flipped backwards here. And so that's a pretty notable thing as they control the bulk of the spare with those two countries.
Yeah, and it seems, from an observer, it seems like they're pretty happy to keep oil in that. I mean, I don't think they want $130 oil.
Yeah.
I also don't think they want $60 oil. But oil, I think in that 80 range, it seems like they feel pretty comfortable with that for kind of a longer term for all their, I mean, they've got a lot of ambitions and stuff as well as to different projects they're working on that are worth trillions of dollars. And there's basically one source where they're getting that funding from.
Well, to your point, I'll just quote one of the main guys at Saudi Aramco, because we've been to the Goldman conference and the Saudi Aramco guys come and talk. And I mean, they hit the nail on the head and they go, we don't want high prices. Don't quit thinking that we want the highest price. We want stability.
Yeah.
We want stability in the market because when you have stable prices, like if you just play out a backdrop of, to simplify this for investors, today oil prices are around number 75. Well, think if they average 75 through the year and oil is like 150, 150, 150 versus 80, 70, 80, 70, 80.
Yeah.
Under one scenario, you're like, I don't know whether I should be drilling or not drilling or building it. Like, and under the other scenario, you're like, sorry, what's the problem? Like, I don't know. I feel okay. Both scenarios, you average 75, but Saudi wants that second case. Saudi and OPEC Plus want stability to the market. That's their number one goal. They don't want this moving around up and down price. They want a stable price that the global market can sustain and doesn't pinch the consumer. They don't want the consumer to be pinched either.
Yeah, and you mentioned it a bit earlier, some themes around AI, deep seek, power demand, that, where the world has basically been going the last few years and where it seems to be, to be heading. And, we had headlines not that long ago, about a big, massive mega center built in northern Alberta and that. Is that currently kind of playing a big theme in sort of where you're shifting the assets around? Is there sort of, call it short-term trades there, or is that more of a longer-term trade?
I'm not sure if we have our appendix in here. Yeah, we do. So look, when we look at what's coming in the next, call it 5+ years, in the next 5+ years, like there is a massive global build out of LNG. And we see US demand going up by 20 BCF a day. So like the US market today is using roughly 105 BCF a day of gas. We see this going to 125 BCF a day of gas. It's a lot of gas. The bulk of that growth is LNG. Less coal, more gas, right? If we have more intermittent wind and solar, well, we should have more base load to support that,
Yeah.
right? Like there's these big structural shifts happening on the global gas market that has nothing to do with energy demand tied to AI. But then a small component of that is this energy demand tied to AI. When we look at the 20 BCF a day of gas growth coming in between now and 2030, 10% of it, or 2 BCF a day, is energy demand tied to AI. So it's adding to the theme, but it's actually making the investor feel like, I think we're going to need more gas. I think we're going to need more gas globally. And all of this in a mixture of the less coal, more gas, energy demand tied to AI, like gas is quietly turning into a growth sector again. And you know as well as me, it was not this 2-3 years ago. It was peak ESG, done with hydrocarbons. We don't need it. We're on to the new stuff. Look how the narrative has shifted here. And I would just pair that with, when I go to conferences and sit down with the gas companies, all the investors are like, don't grow. Give me the money back. Those two things I described are way different. Over here, they're saying I need it. And over here, they're telling the companies don't grow.
Yeah.
This is going to marry itself up at some point. This is the opportunity for investors they already know we need it, but there's a day of reckoning coming as all of a sudden the equities get repriced in our view because this bigger shift that is happening beneath the surface.
Maybe let's talk M&A for a minute. I know Diamondback was active this week. Absent, let's say, a major re-rating, do you think that continues to be a shift where there's just more and more companies gobbling up smaller companies and just getting bigger?
The answer is yes. And look, at the start of cycles, the valuations are too close. When we're coming out of the COVID lows, all of us in the room should just go buy Exxon, Chevron, Schlumberger, C&Q, Suncor. Like, you don't get rewarded for going down cap to buy a mid cap. I'm sure there's all a bunch of mid caps that all of us bought that we are all like, wow, we made a bunch of money coming out of COVID. But risk adjusted, you should have just gone and bought the big boys.
Yeah.
Risk adjusted. As we fast forward the clock to today, because the sector's been going sideways, when you're in the sideways digestive phase, you're in the thaw. And while you're in the thaw, all companies shouldn't be priced the same. There's companies with bigger market cap, with more access to markets and global markets, and they got 70 years of inventory, and they own their own infrastructure. And so what's been happening the last 2-3 years is there's a big divergence happening of the valuations. And today, when we look at the large cap valuations versus the intermediate versus the junior, we are at the widest spreads that we've been at since 2001. And the last time this happened in 2001, and all of a sudden the commodity sector took off for that next wave, which hasn't happened yet, but that's what came, and other sectors quit working, and the money started coming in, it was blow off in M&A. And all the M&A accelerated in a big way because the valuations were really wide from each other. And all of a sudden the gap just closed. And so we're at really wide valuations again, right here, right now. And there's a lot of ingredients. There's a lot of cash in the system right now, right? I always say to our sales guys, follow the cash and good things happen. Well, we forget that with the low Canadian dollar, the prices for our product is really good. It's $105 for condensate for these producers, $100 for light oil, $85 for heavy oil, $4 for gas. These are the same prices as the peak of 2014. We're at the same peak, and think about how everyone loved the sector back then, and everyone's very bearish today.
I think investors do forget that we're priced in USD, and the spread there right now is pretty nice for Canadian producers, especially.
So there's a lot of cash in the system, and good things happen when there's cash in the system. And when the valuation arbs are this wide, you're just opening the door for M&A, and that could mean a couple things. Like, I think we're all watching the same stuff. The world's dividing. Places with lots of people, with lots of resource teaming up with, like, there's divergences happening across the globe. There's going to be countries that go to secure more resource, right? And Canada's screening at you really cheap. The US dollar and all this south of the border, we meet US companies all the time, and the US companies are like, yeah, your resource is way better than ours. You guys have way longer life resource than we do. So this is all happening. But one thing that I would just comment on that is like when we push these US companies on, well, why haven't you come north? Is it Justin Trudeau? They laugh at you going, man, we've had Joe Biden. Like they're the same concept. Like we have had bad energy policy too. But then they go and say, but you Canadians, like, you haven't been able to get your product to market, but you're quietly figuring this out and you're building TMX and you got LNG Canada. So about time you Canadians started figuring this out. And they make the comment of like, I can't come to Canada, buy a $5 billion asset, and then I can't get my product to market. But we are figuring this out as Canadians slowly. And so I'm telling you, the resource is really cheap, right? The resource up here is super cheap and it won't stay cheap forever.
Well, and I mean, when you look at shale producers in the U.S., I mean, I think there's, and correct me if I'm wrong, there's probably an argument to be made there that I don't want to call it that it's sunsetting, but that I think it's getting very close, the geology and maybe the fiscal responsibilities of the companies right now is probably making it very close to, not that marginal producer that it maybe has been the last decade plus, where it would pick up any sort of supply demand imbalances.
Yeah, I mean, to your point, when you just kind of look at the last decade or so, um, global oil demand was 86 million barrels a day. Today, it's like 104, 105. Like the bulk of that difference was met with US shale.
Yeah.
Well, we're at a different starting point today. So when I look at the gas market, like I kind of told you, I can feel the world's believing we need more gas. I can feel it. I do not feel this way in oil right now. Everyone's like, yeah, we got too much of it, spare capacity, yeah, shale, whatever. I've heard this forever. But there is a day of reckoning coming. And there's a day of reckoning coming because the world keeps using more oil. We aren't really investing as much in it. Shale, to your point, is in a peaking process. And I think there's a version of we wake up in 2027, 2028, 2029, whatever that is, and we go, we got a problem here. We haven't been investing enough globally. Shale is no longer in its twilight, and we have not, you don't just flick a switch in the oil industry and all of a sudden you have it. So we see the setup there. We just think it's a little too early on that, right? And that's always hard to time. But to relay this back to 2004, there was all these false starts in 01, 02, 03. But when the back end of the oil curve started to rise because Chinese demand showed up, it just slingshotted the back end of the curve and investors started to go, holy crap, we haven't invested enough. And we haven't had that. When Russia invades Ukraine, the front end of the oil curve went up, but the back end didn't move. Right. And there's going to be a point where the back end moves, which will tell us, Houston, we have a problem. We aren't there yet, but there's a lot of the setup is coming. We can see the setup.
So you mentioned Russia, Ukraine there. Do you think right now we really have any political risk sort of baked into any of the prices of any of the commodities?
I mean, things that we look at, I mean, if you tried to separate it into oil and gas, on the oil side, Russian oil demand is down from where it was, call it 500,000 to 1 million barrels a day. Russia's selling their oil to these other kind of dissident nations and stuff like that. Like, there's still a lot of Russian oil being used across the globe, whether it's China or wherever, right? And so Europe might not be buying the product, but someone else is at a lower discount or whatever. On the gas side, a lot of gas traditionally flowed from from Russia to Europe. And then a lot of these flows the last handful of years have largely gone to zero. And so there's a bit of a fear in the market of if there is a Ukraine-Russian peace agreement or something like that, a bunch of this gas will turn back on and start flowing back to Europe, which will bring down prices. And again, we're not an expert on this, but there's a lot of things that we've read that would be like, I wouldn't just assume that all this gas comes back. I wouldn't just assume that, okay, Trump negotiates a peace agreement, and now all this Russian gas is flowing back to Europe and everyone's holding hands and is friendly again. There's a lot of things on contracts that have been ripped up. And to call it out, Europe has said, I don't want to rely on that gas.
Yeah.
And they're all building out LNG globally to take US gas and Canada gas and Qatar gas and saying, I don't want that Russian gas. I saw how that ended and it ended bad. So the market might react negatively to a headline like that. You might see everyone go, oh, I got to get out of these gas stocks. It's a dip that you should buy because I don't think this gas flows back like people are thinking that it might.
Okay. We'll wrap up here in just a few minutes, but maybe can you just give a little bit of a, I'll say maybe a little bit of a contrast between the two energy funds that we use of yours, the income and the more capital intensive version?
Sure. So, I mean, at Canoe, we manage all of our funds with subsectors, right? Where should we be? I'm just a pie allocator. Should we be in natural gas? Should we be in services? Should we be in infrastructure, midstream, power? We manage all the funds the same. But the two open-ended mutual funds, the energy class and the energy income class, they're slightly different in the sense of the energy class just has a little more oomph. For this part in the cycle, well, we think that's okay, right? When we look at the low weightings of the energy in the S&P, this is when you actually want a little more oomph. But as you know, investors always want all the up with no down. And it doesn't work like that. And so sometimes you want to play the concept, but maybe in a bit more of a risk-adjusted way. And as you think through our energy income fund, this energy income fund pays you a yield to kind of ride it out. It's always hard for guys like me to know timing perfectly and when does this all inflect and when do everyone's smart again and high-fiving on the streets. That might not go on for a while. And if you're getting paid to ride it out, that sometimes serves you pretty darn well to ride the volatility out. So this energy income fund pays roughly 5% yield. And so there's just these companies that are giving us dividends along the way as you're getting monthly coupons to the tune of 5% annualized that allows you to go like, you know what? I can kind of ride this out a little easier and I might not have as much upside, maybe a little less downside, but that's okay for some clients too, right? And there's, I would just say as the client, know yourself, like know.
Yeah, and that's precisely where we use them, just depending on risking of client and stuff like that as to where, you know, where we stage these in. Really appreciate the time today. Any sort of closing things you want to leave us with, Dave?
I mean, to kind of just summarize it all for you guys is very few investors are embracing energy today. Like when I look at how cycles have ended, I managed our funds from 2012 to 2014. I watched our assets go from 50 million to 800 million in a year and a half. Everyone's rolling in. Everyone's giving us money. The funds are up and to the right. Everyone's high-fiving. We had 5 sales guys at Canoe, and with some performance and those sales, it went from 50 to 800 like that. Today, I feel like we're doing well. Our funds are doing well, but there is no embracement. Everyone's like, this energy thing, I don't know, I don't feel like we're the risky asset class. I feel like the world keeps using more energy. There's a very fundamental backstop to what we're talking about, but no one really wants to invest in it because other sectors are where people want to be. This will all change over time. Sector rotation will happen. But I don't want to go to you and be like, today's the day, now's the time. Yeah. I am not saying that. I'm saying start thinking in quarters and years and ride this thematic out because 99% of investors today are trading energy. I bought it, I sold it, I bought it back, I sold it again. 1% of our clients are actually going, get long, go to the beach, buy on dips, and ride this out. And that is the opportunity in our view because eventually the sector will get embraced. Eventually everyone's going to like this sector again, and it'll be fashionable to be an energy investor. In this rough period, or not rough period, in this choppy period, it's harder sometimes because of the headlines and stuff, but there's a lot of good things happening beneath the surface that we talked about on the discipline and stuff like that too. So maybe I'll just leave it with that on just think a little longer term for the space.
Yeah, Pray, and I think that's a good, very good wrap up. I mean, patient capital, allocating capital as it makes sense has always worked over time. And, Warren Buffett will be the first to tell you that. So this has been great, Dave. Really appreciate the check-in, letting our clients listen to you firsthand because they don't ever get to. I do, they don't. So just really appreciate your time today, Dave.
Thanks for the support, and
Yep.
yeah, happy to do these calls whenever. So really
Yep. And,
appreciate it.
and, and thanks everyone else out there that took the time to attend, listen, and we will do a replay of this once it's approved on our website as well. Thanks, everybody.